Welcome everyone. We're very pleased to have this opportunity to sit in front of you and give you our half-year interim statements. I'll go ahead and get started off, and then John will follow up on the financials. First half, we had a great first half at 6% growth at 45 million. We have great conversion, strong cash flow, which John will get into here shortly. And product development is moving along very nicely as planned, as we discussed first part of the year. North America improved 2.1 million over 17 with a good balance across all screed lines. We're gaining new customer growth. First half, 35% new customer growth per units. So that gives us a good indication that there's a lot of work in the marketplace and our existing installed base can't get to all the work. So that's very good signs that the momentum in the marketplace is very positive. Europe had a big improvement as well, 24%. The majority of our sales is coming from UK, Germany, Spain, and France. Revenue from Germany was 1.1 million. The UK was 1.6 million. We sold into 14 countries in the first half here in Europe, which is phenomenal. 23% new customer growth in Europe, which again, very great news. It shows good momentum, good opportunity that we have. Customers are coming into the business, getting new work. China, slightly down, basically due to one boom machine. One of our large line machines are $450,000. So one machine could skew the numbers one way or the other just by a little bit. But we're seeing good activity in the second half. We do have finally our national sales manager on board, Chinese national, that we got on board in July. So we see a lot of opportunity and positive growth in the second half. And we have a lot of good pent up demand. One thing about China and Latin America, it's a timing thing. If we get a signed order today for a machine, it takes a month to 3, a month to 6 months to get the financing and everything wrapped up. So you'll see a lot of the timing things come into effect in China, Latin America, in the Middle East. But China's off to a good start here in the second half. Middle East, as we all know, selling into a very difficult part of the world. We had 50% growth in the first half over last year, coming from the UAE, Egypt, and believe it or not, Turkey. Second half looks just as promising as the first half. And I'm headed there on Friday to spend some time with our existing customers and talk about trading in old equipment for new equipment. So second half looks very positive. Latin America, a little bit slower than average that we've seen in 2017. But once again, the second half, the pent up demand looks very promising. We have some opportunity in Colombia, Chile, Mexico, and Panama. The rest of the world notables, India, we had a great first half compared to last year at 46% improvement. And this all goes down to having the right machine at the right price point. And the S158 and the S485 is the perfect machine for India. It's a smaller machine, it's easy to transport, and it's easy to get around, and you have high utilization. And we do have an in-country sales director on board in India, 2 territory managers on the ground, and then 1 customer service support personnel on the ground. And we're looking to add additional personnel as we move forward here in the second half. Pacific, we had a great first half of the year at 31% improvement across 4 product lines, bringing in 1.6 million in revenue. Next slide, slide 3, just kind of breaking it down to products. Boom screed sales were up 2.1 million, resulting in 60 units compared to 55 in 17. North America had the biggest impact on the large line machines. In total, North America had 37 of the 60 sold in the first half. Europe showed improvement as well, ended the first half with a total of 12 units. Ride-on screed volume grew 18% compared to 17, at 118 units compared to 97 last year. The S485 generated 3.6 million in sales, while the 940 generated 6.8 million in sales. Total, the ride-on category is up just slightly over $2 million. Remanufactured machines are down by 3 units. This is mainly due to the US, and it goes back to the momentum and the opportunity in the marketplace. Customers are buying new equipment instead of buying remanufactured equipment. So typically what you see, if things start to slow down or pick up, on the forefront, they buy the cheaper machine. They're spending the money. So instead of a remanufactured costing anywhere from $190 to $250, they're spending $450. So that gives us a good indication that guys are willing to spend money, they have faith in the market, they have a lot of opportunity in front of them, and they're willing to invest. So these are all good signs. 3D Profiler down by 1 million, but we still had a good first half of the year at 2.9 million. One thing you don't see in these numbers is we generated $400,000 in revenue with customers that have older technology that want to upgrade. And an upgrade wouldn't mean a complete system. It means new software, new laptop, and a new sonic tracer. So if you take the 400, we ended up the first half at 3.3 million, which is still a good first half of the year. Some other notables, the SP16. This is a new product that we launched last year in 2017. Our run rate this year in the first half was 574,000, and we plan to hit that $1 million mark like we talk about with new products. That's our target that we try to hit the first year, and we're on target to hit that at the end of this year. Combined parts and machine accessories. Again, this goes to the momentum in the marketplace. We are $500,000 ahead of where we were last year. So once again, this gives us good indication that the marketplace is extremely busy and we have good momentum. And with that, I'll turn it over to John.
Okay, thank you, Howard. On slide 4, I'm going to walk through some of the financial highlights. As Howard explained, we had 6% top-line growth, and importantly was the balance that Howard just walked through. We had 4 of our 6 territories were increased versus the prior year, and we had 3 of our 5 product categories also increased. So we're particularly pleased with the contributions from a variety of sources for revenue growth. So 6% top-line growth translated well into growth in profits. We had a 50% EBITDA conversion rate for the first half, growing adjusted EBITDA to $14.5 million. That's a 10% growth over the prior year. That also grew our EBITDA margin to 32%, up from 31% in the prior period, so 100 basis point improvement. Our other profitability measurements, profits before tax, adjusted net income, diluted adjusted net income per share, all grew in that 15 to 20% range, so we're pleased with that as well. Importantly, and perhaps most importantly, is our cash flows were also very strong. Cash flows from operations grew 31% year over year to $12.3 million, driven by the earnings growth, but also effective working capital management. In particular, we had a pretty strong collections of accounts receivable, which provided a benefit in the first half. And even in spite of paying $9.2 million in dividends in April of 2018, we still grew our net cash position to just under $21 million to $20.7 million to end June. And lastly, the board declared an interim dividend of 5.5 cents, which is a 100% increase over the prior year. The magnitude of the increase was really driven by an attempt to rebalance the interim versus final to bring it more in line with a 1/3, 2/3 split. In previous years, we had gotten a little bit off kilter on that, where the interim was a much smaller percentage of the final. So we wanted to create a little bit more balance in terms of the payments. So with that, all of the financial metrics, from the top line perspective and even the conversion to profits, we feel very comfortable with. Turning to slide 5, on the operating results, a little bit deeper dive on that. We had very solid gross margins. It actually improved to 57.5% from 56.8% in the prior period. That was driven by a variety of factors. We had some price increases that we pushed through in the beginning of the year, so we had some traction with that. We also had some productivity gains, with the increased throughput in our assembly operations that provided some benefits there, as well as we had some favorable mix. As Howard talked about remanufactured machines, those are generally at a much lower margin than our new machines, and having a smaller percentage of remanufactured machines as a percentage of revenues also contributed to the improvement in gross margins. So in terms of gross margins on a go-forward basis, we view the current level around 57% to be sustainable. We're not looking to grow that or expand gross margins, but we want to maintain that current level. On the operating expense side, we had some growth if you exclude depreciation and other non-cash items like stock-based compensation. We actually grew at about $500,000 year over year, and that was driven by some personnel additions, as well as some incremental spend on sales support expenses and some professional fees. I think what you're going to see in the next half and in the coming years is continued upward pressure on SG&A as we staff up to support new product development and new product sales, as well as increasing our sales coverage and customer support. So we're very focused on adding SG&A in positive ways that grow the business and maintaining our G&A and kind of support function costs to be within reason and in line. So with that, we also had a positive impact from the effective tax rate. The U.S. statutory rate's at 21%. We had an effective rate in the first half of 22% due to the impact of some state taxes. We expect that to be the going rate on a go-forward basis. And if you look at a comparison to prior year, it was actually slightly up. And that's because in the first half of 2017, we had significant benefits from stock option settlements, which was a one-time event. And lastly, capital expenditures were $600,000 in the first half, which is in line with our run rate, which is about $1 million, $1.5 million, excluding construction projects or building projects. We are, as we noted in our earnings release, we are in the process of assessing expansion of our Fort Myers facility as well as our Houghton assembly operations to really support the new product launches that we expect in the coming years, as well as core business growth. So that's something we're going to be reviewing in the first half of 2019, and we expect to make decisions on the level of CapEx at that point, and then start construction projects in second half of 2019 that'll continue into 2020. And with that, I'll turn to the balance sheet on slide 6. We talked about the cash position of just under $21 million. That was driven in part by some benefits from reduced accounts receivable. At the end of 2017, we had a number of deals that came through at the very end of the year in Europe and in the US, which we collected in first quarter, and now we're back to a more normalized level of AR. That was offset partly by an increase in inventory, which is partly seasonal and partly to keep pace with the growth of the business. So we do expect in the second half to kind of maintain working capital levels at or around the current balances. So in addition, we do expect that on accounts payable, accounts accrued expenses will have kind of similar levels. So turning to slide 7 on the cash flows, it's a pretty straightforward story. We had strong operating cash flows, which in effect funded the payment of dividends to shareholders. And as everyone recalls, we did change the dividend policy at the beginning of last year, where we increased our payout ratio to 50% of adjusted earnings, and we also put in place a supplementary dividend, which calls for the distribution of excess cash, 50% of the excess cash over $15 million at year end. We feel comfortable with that current policy, and based on the current trajectory of our cash balances, we expect there'll be a meaningful supplementary dividend that will be paid in April of next year. So with that, in terms of the financial review, we'll jump over to the trading and outlook statement, which is obviously very oriented towards the top line and more specifically the health of the markets that we operate in. In North America, as Howard mentioned, we have a very constructive environment, very positive environment that's really highlighted by the healthy customer confidence. Being a direct sales organization and direct support organization, we have a lot of feedback from our customers, in particular based on the work that's in front of them, their project backlogs, which based on our input and discussions with them, customers have project backlogs that span the rest of this year and into next year. And as Howard mentioned, we saw 35% of our unit sales went to new customers in North America in the first half, which is a strong indicator that there's more work than the legacy customer base can handle, so there's more new entrants into the business, into the industry. So we feel very good about the positive conditions in North America. In Europe, we also have a very positive environment in terms of non-residential construction. We're particularly pleased that we sold into 14 countries, which highlights the breadth of the contributions there. And the point to note within Europe is that there's a an older installed base of equipment. The European customers have been slower to refresh, so we see an opportunity for customers demanding replacement equipment, upgrades for technology, as well as some of the new products that we've launched since the financial crisis. So we continue to see a strong runway in Europe, and we feel very good about the environment. Within China, we obviously had a relatively flat year-over-year comparison, but we've continued to take steps to improve our traction in the marketplace. One of the key elements was the hiring of the national sales director who joined the organization in July. So we believe that local leadership will be a key element to driving that business forward. In addition, we've been launching a series of marketing and demand generation initiatives earlier in the year that we're seeing some early returns on. So we feel like in the short term, we're going to be driving improved performance, but in the long term, we still continue to view China as a meaningful long-term opportunity, but the gating factor will remain to be gaining traction with the acceptance and demand of quality, which is our core targeted market segment. It's basically customers that provide quality floors in the marketplace, and we will continue to push that forward. With respect to the rest of the territories, we see lots of opportunities, particularly, Howard talked about Middle East, but we also see a number of opportunities in Latin America in the second half, a number of projects that are in our sales funnel. So we feel good about the second half performance in Latin America that we expect. And then we obviously have a lot of rest of world opportunities as well, India being one of them, where we're continuing to see some traction, and we're very pleased with the early returns in India. And then when you take the entire picture in terms of the health of our overall geographic footprint and the take rates across our product lines, the board is confident in the company's ability to provide a second half that will be causing us to meet our 2018 expectations in terms of the market. So with that, we're going to turn to a strategic strategy update that Howard's going to walk through.
Yeah, if you all turn to slide 10, as John mentioned, nothing has changed in our growth strategy going forward. International expansion and new products. As we mentioned before, we try to come out with a new product once a year. We're working in the structural high-rise market. So no changes in our growth strategy going forward. We're making investments in international markets such as China and India, and that's going to be continuing going forward. Slide 11, as we talk about China, why isn't China growing? And we've been trying to figure that out since day one. Of course, we had some great success first few years, and things slow down and competition comes into the marketplace. But taking a deep dive, and we spent a lot of time there. I personally spent a lot of time there, and I just came back from China in July, trying to understand what can we do to drive the quality perspective, as John mentioned. One thing we found out was there was a huge disconnect between the developers, the building owners, and their tenants. So the building owner puts a building up, does the floor, turns it over to the tenant, and they walk away from it. The tenant was spending thousands of dollars grinding and patching the floor because it wasn't flat and level. The developers had no idea, or maybe they had an idea, but they didn't do anything about it. So what we've done, we went to the developer, say, look, this is what we learned, because I personally sat in front of the tenants, and they had no problem telling me how much money they're spending and what it's doing for the business. So I sat with the developer and said, do you realize how much money your tenants are spending? They had no idea. They said, look, if you can provide a quality floor, which reduces their cost of ownership, I said, you can charge more in rent. And it was like a light bulb went off. So in November, we are getting both sides together in a forum. We're going to have the tenants on one side of the table and the developers. We want to get everyone on the same page and driving for the same thing. And what we want to do, the outcome of this, is to provide the services for the building owners and developers to learn how to put in a good floor. Now, this is a piece of a big puzzle. This is, again, driving for that quality standards. And this is just a piece of it along the way. And this goes into our growth strategy. As John mentioned, we added a sales director on board. We're adding marketing, inside sales. We're doing all the right things because we know the market's there. China is umpteen times bigger than the US. Even with that alone, if it's 10 or 15 times bigger than the US based on cement consumption, we still know it's bigger. we still know there's an opportunity there. So that's why we're focusing on the quality side of the market. Now, there's also the productivity side. The productivity side is the small line machines. The large lines, the quality, the boom machines. Productivity is the small machines. We have a 158C that we introduced in China at a lower cost to compete with our competitors there, and we're making some great progress there. We ship the machines over in modules, and we have a local manufacturer put them together. So that reduces the import cost and tariffs and everything else. So we are making some improvements. We're making some headway. You just really don't see it in the numbers. And it's going to be a slow progress. And we're not going to, what we talk about, the big hockey stick that we all are hoping for. But we know there's an opportunity, such as we know there's an opportunity in India. India is a little bit different than China. India is a driver for quality. They want quality, and they want it big time. 2 months ago, they just introduced standard specifications, which is great for us. So if you do a floor, your floor better meet this. Now, they have this in China, but if you don't meet the standards, it doesn't matter. They do nothing. In India, it's going to be a little bit different story. So we were right at the right time to be in the marketplace when things are starting to pick up. So with that, I'll turn it over to any questions you may have.
You mentioned China as being a much bigger market, but Europe is also the same size as the US. Mm-hmm. So why don't you sell more than a fifth of the number of machines in Europe as you do in the US? Why is there that disconnect?
Yeah, well, I think the biggest part of it is, again, it's once the quality side of things. Of course, there's a lot of large jobs going on, Amazons. Actually, there's 4 Amazons going in Italy. But there's not a lot of those big players that are doing that type of work. I mean, we have a good install base here in Europe. And as John mentioned, the trade-in replacement cycle is very slow. Customers in Europe tend to hold on to their equipment a little bit longer than the US. The US is easy, number one, because I live there. They treat their equipment like a car. Usually 4 or 5 years, they trade it in for new technology, or they just trade it in because the old one's it's pretty ragged. And they want to be seen as leaders in the marketplace. They want something new. And their utilization is more so than what you would see with the same type of contractor and the amount of employees here in Europe. So Europe tends to hold on their equipment a little bit longer. But what we're seeing in Europe is not on the large line side of things, even though we're getting large line opportunity, is the small line. And the small line is easier to tow. Regulations, I don't know if you know regulations here. So in the US, you can put a big machine on a truck and you go. And here in Europe, it's very difficult. You need a certain size truck and trailer to haul it. A lot of customers don't have that extra 100,000 pounds or 200,000 pounds to buy that equipment to haul that big machine. But they do have the equipment to haul the smaller machines. So that's really where we're seeing a lot of the growth coming from these smaller contractors needing smaller equipment to be able to pull it around. But there is opportunity in Europe. One thing that we have been doing for a while is a replacement cycle. And we take trade-ins for new, it facilitates a new sale. But in Europe, if I gave you a trade price in Europe, I know that I'm going to have $10,000 to ship it across the pond to remanufacture in the US. I can't resell that machine back into Europe because of the Tier 5 emissions compliance. It got to have the updated engine. I can't put an updated engine in an old frame of an old machine. So I couldn't sell it back. So what we have done 2 months ago, we started offering trades here in Europe, and I keep the machine in Europe. As John mentioned, I think the first part of the year, we're moving into a new facility, which we just did. And this is going to be a lot bigger. We have more space, and we're going to be doing some remanufacturing there. Now, not to the level that we do in the US. Right, in the US, we take it down to last nut and bolt, sandblast it, repaint it. But we're going to do it to about an 80% level than what we do in the US. So that provides us a good opportunity to show a customer a little bit more for his machine because the value is there and I don't have to ship it back over to the US.
And there's 2 other quick ones. It's a very fragmented market versus the US, which is much more of a kind of contiguous market. And the project sizes are much smaller, often in Europe, which doesn't necessarily lend itself to our large pieces of equipment. So it's a different type of environment to sell into.
One of the concerns that I and possibly other investors have is that most of, if not all of your revenues are from machine sales. Do you have any meaningful recurring revenues? Do you see any ways to grow recurring revenues?
So currently, about 15% of our revenues comes from parts, service, and sort of billable, billable items.
Billable.
So, it's over time we've tried to explore ways to create sort of a recurring revenue stream, additional recurring revenue streams, and we continue to look for them. But it's safe to say that we will continue to be primarily a machine revenue business. And even with increased recurring revenues, it still would fall under an overall cyclical environment. So the recurring revenues wouldn't necessarily insulate us from a cyclical event. So it's something that we review, and we try to find ways to increase it, but reality is even increasing it would be on the margins.
And compared to the first half, we're 500,000 above in parts and accessories compared to last year.
The Middle East, India and China are notorious for being difficult to collect payments from. What has your experience been of that? What are your typical trading terms in those markets?
So we require payment in advance, or commitment from a letter of credit, or a commitment from a financing company. We really don't extend terms in those territories. There's certain other instances where we will extend terms, but generally, if we were to extend terms, we use our machine shut-off feature in our equipment, which has been the most effective way to ensure collection.
My final question, I just want to clarify, is Somero the brand that's associated with your machines?
Yes.
Yes.
Yes,
right.
it is. Yes.
And what are you doing to build that brand and brand recognition?
Well, from all the marketing efforts that we've been doing over the past umpteen years about brand recognition, we're continuing to do that throughout the world. We have marketing pieces specifically for China, the US. India, we finally got their own website up and running. So we're doing all those things independently of each country.
Yep, and we have a relationship with an outside marketing firm that sort of is our brand police to ensure consistency of look and feel across our footprint. And we have absolutely increased our branding efforts, as well as the sort of field marketing, which is more driven towards generating sales.
As the market gets bigger and more regulations regarding quality come in, what are your concerns about a serious competitor appearing, maybe one of the big name construction machinery companies?
So with respect to competition, we're always going to have competition to some degree. And the competition that we see in the marketplace, and this goes back to the 1980s, where there was the first competitor who attempted to reverse engineer one of our machines, build a machine, and attempted to sell it into the marketplace. The way we look at competition, the reality of it is, what truly puts the moat around our business is the service, the support, the reliability of our equipment, as well as the expertise in training our customers how to put in place a quality floor. That is very difficult to replicate. So entrepreneurial, businesses that want to create a knockoff machine outside of our patent protections and sell a machine into the marketplace, it's not accepted because you need a machine that will absolutely be reliable, have somebody standing behind that machine to ensure that if there's a problem, there's immediate troubleshooting. If there's a parts issue, we have next day parts delivery. And that's just, given the high risk of this particular industry, the concrete contractor industry, that's critical to basically maintaining that confidence of the customer base. So with respect of the larger players coming into the marketplace, we have a kind of a protected niche market where the large players such as a Caterpillar, et cetera, really don't have interest in coming into a market this size, and they have even less interest in coming into the concrete industry because of the risk that's associated with this particular industry. And we have a tremendous advantage because we're a direct sales and support organization. So we have a tremendous amount of customer loyalty that we've built over the years. So it makes it very difficult for a meaningful competitor to emerge. And the reality of it is that we really focus on providing value to our customers and deepening those relationships and really not paying too much attention or focusing on entrepreneurial competitors that may appear in the marketplace.
Could I ask you two questions? One, about China. You've been trying to get into China for some years now. And do you think your model is going to work in China, or do you adopt a different model? can they afford your equipment? Or do you have to have different sort of terms with them? You've appointed a sales director. Is he just going to behave as your other sales directors do everywhere in the world? That's my first question.
No, good questions. We do look at the right product for the right market. When we originally went into China, we thought, okay, China, they can buy U.S. machines, right, at our price point. That's further from the truth. And that's why we came out with the S150HC, as I mentioned earlier, about our local manufacturer putting the modules together to reduce the cost. You're absolutely right that we have to have the right product at the right cost point. And we look at those things, and we've made some adjustments along the way, and we've identified what are the right products going into the marketplace. And keep in mind that each product lends itself to a different type of application, whether it be small or have certain quality demands. That machine would depict on what it could do on that certain project. So we do look at all the products across the board to figure out what is the right product. And as I mentioned earlier, with the 158 in India, it's similar to the one we have in China, but again, it's the right product for the market.
Do you have to advance any finance at all, or you just have the same model, somebody has to buy the equipment?
So in China is one of the areas where we actually do offer extended terms. So we offer up to 24 months financing. We'll charge a kind of a market interest rate and allow customers to finance the machine. The reality is we had to step into the marketplace because there isn't a financial institution that we could partner with that was interested in a business our size. So we're kind of the plan was to step in on an interim basis until you get enough scale and interest from a financial institution that we could partner with to refer our customers to. The reality is by offering those terms in the marketplace, customers still, that isn't the primary choice. So a third of our deals are cash paid in advance. A third of our deals are terms 6 months or less, and a third of our deals are the longer term financing. And the collections are assured by the equipment shutoff feature, which we've had no delinquencies and no issues with all the deals that we've done since the fourth quarter of 2015. So financing is an option that we've provided. It isn't the sort of silver bullet. You know, we continue to view acceptance and demand for quality to be the gating factor to truly growing the marketplace, and that's where we're very much focused.
Is there any sign of a Chinese institution getting interested in financing your machines for these customers?
We do. We have some relationships that we started to develop. We've made some referrals to them on an initial basis to get some deal flow through them. And the expectation is that we'll continue to grow those relationships. But at this point, we're still the primary mechanism to do the 2 years financing. Now, I will say some of our customers are able to get financing on their own through banks or financial institutions that we're not a party to. So financing has not been the sort of issue in terms of really driving the market. We think we've addressed that and provided some reasonable options to the customers. You know, it gets back to kind of getting enough demand for quality floors that really is where our sweet spot is.
Second question about your vertical machine that you talked about last time. What is it? How's it coming on? What do you do? Are you selling it?
Well, our plan is still to launch this in January of 2019 at the World of Concrete. And we're still working through the development side. We have alpha and beta in the marketplace. We're testing on various projects, and we're learning a lot. We're learning a lot about the value to it, why would someone buy it, and what are the benefits of ownership. And we're making some good progress. As we learn in the field, we go back and make some changes. We get it back in the field. Another thing that we're learning is that there's other applications for this machine. So look at this machine as it can go anywhere else our current machines can't go, because I'm sitting in one location and reaching over. And it can be transported or lifted with a crane. So just looking at the structural high-rise market, that progress is moving along nicely. Of course, we learn things as we go, and we had hiccups along the way, and we'll continue to have hiccups, but we still plan to launch this the first part of next year. And as John mentioned on the SG&A side of things, this is going to be a brand new sales team that's going to be focusing on selling this. Now, our current install base, some of our customers do structural high-rise, but not many. So in order for me to have 100% laser focus on this product, I got to have my own sales team focusing on selling this. So, and things are moving along nicely. And as I mentioned with new products for the first year, you don't really get that hockey stick in sales right out of the gate. This is going to be slow growth, but we know that there's an opportunity. This market segment is huge, and it's all around the world.
But it's also likely, from what you're saying, to be to a majority of people who are not yet your customers because...
Yes, absolutely.
Right, okay,
Yeah.
thank
and
you.
all of this market segment, everyone's doing it by hand. Just like it was in 1988 when we introduced the first laser screen. Everyone was doing it by hand, myself included. So this is a huge upside. And the customers that we've tested with, we have a council that we put together, 6 contractors that all they do is structural high-rise, and that's who we test with. And we're getting some good feedback.
And thank you for being
Yes, thank you.
such a good company and making shareholders so much money. Thank you very much.
I was just looking at the appendix with the financial highlights summary going back to 2007. And I guess one issue which is going to be of significant interest to many future investors is when the downturn is going to come. No sign of that in the last set of results. But can I ask, what did we learn from the last recession? And the second part of that is, how did we manage to get our SG&A cost base down from 27.4 million to 11.5 million in 1 year?
So
how was that achieved?
So that's a very good question. I think the start of it to understand is we're a high variable cost business, and our primary cost is personnel, people, staffing. So we're able to we're nimble enough to be able to adjust to changing market conditions and adjust our cost basis to right size to the level of volume we have. Some changes from the financial crisis in terms of what we are today versus then is we're debt free. We have a very strong net cash position, and we're much more diversified in terms of where our resources are and some opportunities in terms of our revenue streams coming through. North America continues to be a very big part of our business, but we have opportunities for growth in all the other territories, and we have increased our breadth of product lines. So we've taken steps to increase the diversification of the business. We have a much stronger financial position, but we remain to be a high variable cost business that's really driven by personnel. To answer your question about how that decrease in SG&A occurred, it was very much driven by headcount management. And the way we protect against that is we have a core group of managers that we protect by having retention programs in place that will manage the business through any kind of condition. And with that, we know we have the critical mass to manage the business in the worst of situations. And we would certainly hope in future, when there is a downturn, and there will be a downturn at some point, that it isn't, we would hope it isn't global, and it isn't certainly as deep as what we experienced in the financial crisis.
Sorry. I was just going to add, some of you asked about indicators, what gives us a sign that things are slowing down. As I mentioned before, the parts volume. If the consumables start to slow down, and we see that start to slow down and customers not ordering enough consumables, that's one indicator. The second indicator is our call volume. I track that on a daily basis. I know how many calls are coming in, what they're coming in for. So if that starts to slow down, that tells me customers aren't using their machines as much as they did before. And we track that on a daily, monthly, yearly. And also, to add to that is, as John and I mentioned, we're a direct sales team. We're sitting in front of our customers, 300 of them a month, asking them, how busy are you? Where do you have work? How much work do you have? Do you have any backlog? All those kind of things. So you put those 3 things together and say, okay, what do we see here? Because I was a part of the 2 restructurings we had, and very difficult, and John's right, it's all about personnel. Those were the leading indicators that gave us an idea, or not gave us an idea, indication that things may be tightening up. Now, 1 month, you have that 1 month, say, okay, 1 month's 1 month. But when you start seeing a trend, then that's a good sign things are slowing down. Okay, what are we going to do?
Thank you. And final quick piece. I see that our gross profit margin seem to have reduced by 6 or 7 points during the years 2009, 10, and 11. Was that a concerted decision on our part as another strategy for dealing with the recession? What was that? Price reductions?
It's purely a function of a much more challenging market condition. So when the recessionary conditions occur, pricing gets pressured. There's still business to be had even in the worst of conditions, but it certainly places a lot of pressure on pricing. So the expectation is, in the event of a cyclical event and there's a downturn, it will put some pressure on gross margins. And obviously this was very significant pressure based on the depth of the financial crisis, but you would expect to see the same pattern.
Thank you.
Sure.
I think your unit sales were up 4% and revenues were up 6%. Is that difference just mix, or are your prices actually of your machines increasing or stable, or what?
It's primarily a mix discussion. We had strength in our boom screeds, which are much higher average selling prices. That explains the majority of the difference between the 4% and the 6%. Pricing was a much lesser element to that increase.
Okay. And sorry, and to come back on to the last question, just with a different angle, on Latin America, I know that's a very small part of your business and you're quite bullish for H2, but you've obviously seen a massive decrease in sales in H1. Were the sort of indicators that you were mentioning then factors that you could see that H1 was going to be poor a little while ago, or what's, I know you can say you're probably talking 20 sales down to 5 or whatever, but what
we look at the sales opportunity we have in the funnel and the sales that we have signed. And as I mentioned before, the timing thing, right? I could have gotten a signed order maybe in March or April, but it didn't happen before the half year end. So it's a lot of that is the timing. But what we really look at, because timing we have no control over, right? I mean, we can control from the time I meet a customer to the time he signs the order. Those are the things I can control. The things that I can't control is his banking and financing. Because once he works with his bank, which we have no contact with, it takes time, because getting their financials together is a little different than getting financials together here in Europe and in the US, because they have so many other things that gets added on top of it. So those things take time. And once that's out of our hands, we really don't have much pull one way or the other to try to get him to move forward. Now, there's some things that we can do, getting LCs and stuff like that to try to pull it forward, which we do all the time. But a lot of these things, when you see like Latin America, it's really a timing. But what we really look up is that pent-up opportunity that we see, of course, going into the second half. And we do have some good opportunity. So.
Actually, Howard mentioned before about sort of the project mobilization. So a lot of times customers have visibility to a project that they know they've been awarded the project and it's expected to start on a particular date. But until they get that firm commitment from the developer, they are not ready to purchase a machine. So them signing the sales order oftentimes is predicated on them basically getting the instructions to mobilize, and we're going to start construction on this particular date.
And that's not only in Latin America, that's the US and Europe, where we always talk about the trigger job. So for someone to step up to the plate and order a machine for $450,000, you add tax on that, they're at $525,000. They have to wait for that trigger job to start, or that job to start that they need the machine on. If that job was originally supposed to start the first of the month, and for some reason it didn't, it pushed out until next month or the month after that, the customer doesn't want the machine because, number one, he has to pay for it before we deliver it, or his financing kicks in. So he doesn't want to make his monthly payments until he truly needs it, because he doesn't want to sit it in the backyard. And that's what we see all around the world.
Can I just one final question on aluminium? I understand aluminium's a key raw material for you. We've got tariffs, but if we had significant Russian sanctions, is that a concern for you?
No, so the way we think about tariffs, it's two pieces. So there's the domestic piece, and then there's the international implications. On the domestic piece, we have seen some surcharges on metals and aluminum that have come through. we're no different than any other OEM or any other building material supplier. So in the industry, our customers are seeing, increases in costs relative to these inputs. We've been able to pass those costs off onto our customers through price increases. So we've been able to negate the P&L impact for us. And a lot of the other OEMs that sell related equipment in the marketplace are doing the same thing. So we're not alone in that. On the international side of things, despite all the discussions about tariffs, we have not seen any issues in terms of our ability to export our products into foreign countries. Russia is not really an area where we have currently business.
Yeah, sorry, I was more thinking about US sanctions on Russia that could create a real shortage of aluminium globally, or there's talk about that in the press. Is that?
It's possible, but I guess one thing to also note is the aluminum is not a major part of our cost of goods sold. It's a relatively minor element.
Just looking at your presentation photos, there seem to be a lot of warehouse distribution centers. Presumably for these kind of sites, a level floor is very important.
Yes.
Is that your main customer base, the kind of Amazon type companies?
Yes, I mean, the Amazon, the Costco's, the Carrefours, the big box retailers, commercial, absolutely, that's a big part of our business.
And then if that's the case, presumably there's a lot of kind of end customer pull factor for your kind of equipment, with the e-commerce companies saying, look, we need a really level floor, to the real estate companies. So is that possible for that to kind of any kind of customer pull through in China and India and so forth, in terms of these e-commerce companies saying, look, we want these level floors to the warehouse builders. Could that help your business take off in those kind of markets, perhaps?
Oh, yes, absolutely. So to give you an idea, if someone's doing a floor manually, and the way we measure a floor is what we call FF and FL in the States. In Europe, it's TR34. And it's measured by using optics. It's a guy on a survey scope, and he measures the difference in a certain grid. To do that manually, the quality of the floor is terrible. You could feel the humps and bumps and dips and everything. So when a contractor is doing floors manual and he wants to bid on a job that has certain specifications, and those specifications are higher than what he can do manually, he has to have a laser screed. There's no way around it. Now, whether it be a ride-on screed or a boom screed, they both provide quality floors. It really depends on the size, depending on the size of the placement. So if I want to place this room with concrete, I'd probably use one of our small machines or small ride-on. I wouldn't use a big boom because it's not big enough. But if I'm on a big project and I want to do 10 times the size of this room or 100 times the size of this room in one placement, I'll use the big boom machine that I mentioned at $450,000. So all of our machines provide quality over and above what they can do manually. And as a contractor, former contractor, when I seen a job come across that had quality specifications, I knew that I got to use a laser screed. And that's what we're seeing in the States and Europe. When customers are so busy with their current work and current machines, they continue to bid. And as work starts to pile on, they don't have enough equipment to get all the work done in a certain period of time. So that's what we talk about when we say fleet additions and everything. Customers adding more equipment on because they have so much workload.
And so your question actually is exactly what Howard had spent time in China really zeroing in on, which is the demand for quality, which is coming from the end users and the developers. And it's really making sure that it's promoted and it's accepted. Now, generally, multinationals will come in and require a certain quality floor, and in many cases, they're not getting it. So really, we're doing exactly what you're suggesting. We're trying to promote that pull through, both from a multinational perspective, but also kind of domestic developers, to really accelerate that process, which Howard said the only way to deliver that quality is the use of our equipment.
And you mentioned the cost of a low quality floor. Is that things like robots falling over or people falling over? Is that
both? So if you're talking to warehousing, of course, the speed that the forklift can pick up the product off the shelf and get it back to the loading dock, that's efficiency. And the only time a warehouse can make money is efficiency, getting the truck unloaded or loaded. So if a floor is bumpy, that forklift can't travel 6 miles an hour. It has to travel 2 miles an hour. The other thing is when he picks his product off the top shelf, which could be 30 meters high, they typically reach and grab the product, and as they bring the product down to the floor, they're still moving. They're moving down the aisle. So you can imagine a product being 40, 50 feet in the air, traveling at 2 or 3 or 6 miles an hour. And if the floor is uneven, that product's going to fall off the forklift.
And there's also a lot of repair costs as the floors degrade over time, so that's sort of the remediation cost that often is borne by the tenant, in addition to the inefficiency of the operation.
And also to add to that is the repair work of the forklifts. If you take a look at why does the forklift break down, it's the tires, the shocks, the suspension, and it's all because of the floor. They design forklifts around terrible floors. And the cost is through the roof. As I mentioned earlier, the tenant's spending a lot of money. It's in the floor, but it's also repairing their forklifts because they just get beat up.
They're not required by health and safety to have a certain level of a levelness of floor?
Well, their standards and specifications are already in place in China, but no one enforces standard and specifications. They're not adhered to. It's text in a book, and that's fine, keep it there, and we're going to give you a floor, and that's the best we can do, and you're going to have to live with it. As John mentioned, the multinationals early on, when they went into China, we said, okay, they said, we want a floor in China like we get in Europe. Not happening. They came to us, and they said, what can you do to help our customers put in a quality floor? So at that point in time, we knew that we had to educate the market and drive the demand for quality. And that's what we've been doing since day one. And it continues to move forward, and we learn things as we go.
Hi, yeah. Can I just ask, in terms of creating the pull-through from the customer, aren't you best trying to get it specified by the architect? And that way the architect then specifies it, and then the developer and the builder has to use it.
Has to use it, yes. That's what happens in Europe and in the US. The architect or engineer specifies a floor, and they don't specify you got to use a laser screed. They specify your quality has to be this, and knowing as a contractor to get that quality, I have to have a laser screed.
So that's where your lobbying needs to be,
yes,
in the China and other countries, I suppose, isn't it? Yeah.
We have a team of sales engineers that do exactly that, where they basically provide education to building developers, but also architectural firms to really illustrate the value of flat floor.
And there's more to it than just using a laser screed. It's wide placement. Traditionally, when a contractor is placing a floor, the forms are very narrow, maybe 20 or 25 feet apart. Using a laser screed, you can pour 200 feet wide. So what does that mean to you? Well, to a contractor in a building, it means a lot. Because every time I have a construction joint or a break between pours, that forklift will beat that edge to no means. And it'll just fall apart. The forklift have trouble going over the edges and everything. So going to wide placement, reducing the construction joints, not only improves the floor, the quality of floor, but also reduces the labor to set up, to do the forming. So you put all these things into a hat and show a contractor and a developer, here's what a laser screed can do for you and for your customer. And it comes up to some big numbers.
Presumably the product for this new market is small?
You know, one of the important things about that particular market segment is it's a very large market segment, but it also has sub-segments within it in terms of different types of projects. So we envision this to be a relatively long-term process where we come out with a series of products geared towards certain of those segments. So, you know, what we come out with initially may not necessarily be the only thing. It'll be multiple, hopefully, follow-on.
And just case in point, we have 13 types or 11 types of laser screeds now. The first machine we came out with was a 240, like the S22 that you see today, the big machine. And as time went on, customers are saying, well, we need smaller machines because we like to do this size of job. Then we started looking at, okay, we need to design and develop a smaller machine.
Thank you very much.
Great, thank you.